Hey everybody, thanks for checking in to our quarterly investment review for the Counsel Conservative Portfolio. My name is Arnold Machel. I'm the founder here at VisionVest Financial. If you're tuning into this, it's probably because you got an email from us saying, hey, this is your core holding if you want to check it out. But it's also possible you're somebody brand new, you're just sort of checking out the conservative portfolio or checking me out. We're going to give you a quick update as to what went on the slides. A lot of them that I have here are only as at the end of March, but I'm going to give you more updated information as we go along. So if you're invested in this portfolio, it means you're looking for a conservative way to grow, but you also want to protect your capital. And the way that we do that is we have a lot of fixed income in there. 60% is the target asset allocation, although it's closer to 65 to 68 right now. I'll explain why in a little bit. But what I really want to point out is that this is truly a portfolio more than it is a fund. I mean, it's classified as a conservative fund, but really it is a mix of 17 different funds, so it's truly a real portfolio. I'll point out two of them in particular to you. The Global Trend Strategy is a style. Mount Lucas is the manager of that style. The U.S. Growth is another completely different style. Morisco is the manager for us, or for this portfolio, of that style. We're going to look at those two pieces of it in a little bit more detail, but basically understand that you've got 17 different managers, 17 different styles working for you to give you access to global financial markets with multiple asset classes and complementary investment styles. Now, those are investment styles that zig and zag against each other. The portfolio dropped 7.43% as at the end of March this year. Now that's in contrast to a 23% drop in the Dow, and it's actually gained back most of that. It's only down about 2.9%-ish right now. And that's well within the range of what we would expect it to do periodically. On the right-hand side, you sort of see two charts there. One is this one-year graph, and then below it you see the one-year numbers. The brighter green square that you see there corresponds to this most probable return right here. Most of the time, 70% of the time, that this portfolio is going to earn between minus 1.5 and 11.1%. I should point out these are gross of fees, and so whatever your advisory fee on this is, let's just call it 1.5%, drop the return by that to get a sense of what you would expect out of the portfolio. So most of the time it'll range in the minus 1.5 to 11.1% range. This is over 1 year. But once in a while, once every 4 or 5 years, 30% of the time, it's going to go outside that range and end up falling as much as 14% or going up as much as 22.5%. So still a bit of variability there, but what we've experienced in the last year, very much in that normal range. The other thing, though, to point out is that expected returns compress quite a bit when we think in terms of you holding on to this for a longer time period, like 10 years. More realistically, you're looking at 4.4 to 7.2 in terms of the range, and most likely between 4.8 and 6.3, just to give you a sense of what you can expect out of this. All right, I said that the target asset allocation is 40% equity, 60% fixed income, but really right now it's closer to 65, and the reason for that is that global trend strategy that I mentioned before. It represents 8% of the portfolio, and they were light to bonds going into this, only about 11% in short-term US bonds, but they moved almost to 100% bonds, and settling down to 87, and today they're around 78%. So slowly reducing their exposure to bonds as markets are improving. And that really did help mitigate the decline. It's the reason that you didn't fall near as much as the broad market if you're invested in this portfolio. One of the things that I love about not just this portfolio, but all the Counsel portfolios, is that they actively manage currency hedge. They were 50% hedged going into this. They've dropped it to 0 right now, basically with the belief that the Canadian dollar is going to decline. And so that's one of the things that they have done to value. What worked? Well, having that fixed income really worked for us. Long term, that reduces the return, but it really does protect us on the downside. Another actually surprise was U.S. growth. We'll talk about that in a little bit on the next slide, but at first it was a surprise. Once we drill down into, hey, why did this happen? Well, Amazon, for example, is one of the big companies in the U.S. growth sector, or Microsoft that we're running this presentation on. Those are companies that have done well throughout this time period and probably are going to do well due to the pandemic. So when you looked at it, all of a sudden, it's not such a big surprise, but important to have that style of investing in there. Growth is one of the main styles of investing. Value is another one. Frankly, value has underperformed, not just throughout this environment, but for the past few years. Sooner or later, that'll switch back. Value will do better and growth won't. Again, that's the diversity. We want to have the different styles in there that are zigging and zagging against each other. And that's really one of the main things that I can say about this is the effects of the diversification that we had in this portfolio really paid off big time. You can see here the different sectors that are inside the portfolio, or the different components of it. And as I said, U.S. growth, fixed income, short-term bond, those are all categories that created positive performance for us. Now, these figures are as at the end of April. This has been even strengthened more in the past month. Today we're approaching the end of May right now. Every other sector, so those three did well. Every other sector did poorly. You can see that they're negative. And what did the worst? Value and dividend, right here. Probably the most important thing that I can say to you is the importance of keeping a long-term perspective. Just take a look at this. This is the TSX, so the Toronto stock market. You can see here, every time we've had a 12-month drop of over 20%, so that's what it looked like in the last, well, since 1957. Every time we had a drop like that, 5 years later, returns were great. The worst being 8% a year on average. But even 12 months later, 1 year later, 5 out of those 6 times, it was positive. Now, one of those times it wasn't. So there's no guarantee that 12 months from now things are going to be positive, but the odds are very, very high. Thanks for tuning in. If you are a client of ours, you know how to reach me. We'd love to chat with you if you have any questions at all. And if you're not a client of ours, here's our contact information. Just pick up the phone, give us a shout. We would love to chat with you. This has been a VisionVest Digital Discovery webcast brought to you by Arnold Machel, VisionVest Financial, and IBC Investment Corporation. Thanks for listening.
I'll have less to worry about until the day they carry you out. If I save $1 million and reinvest that $1 million, well, I'd buy Arnold lunch. He'd deserve at least a good sandwich. If I'd save $1 million, I would say